Exam Scholar, Real Estate Edition. What are 1031 exchanges? A 1031 exchange, also commonly called a like-kind exchange or starker exchange, is a term applied to an exchange strategy that allows real estate investors to exchange one property for another whilst deferring the requirement to pay capital gains tax. It gets its name from the Internal Revenue Code, also known as IRC, Section 1031. This code has various moving components, and it's important to understand all of them when taking advantage of the tax benefits. As of the 2017 Tax Cuts and Jobs Act, only real property qualified for 1031 exchanges, while previously personal property such as aircraft, franchise licenses, and equipment also qualified. Now, if an investor is looking to utilize a 1031 exchange strategy, they need to first know that the properties being exchanged must be like for like. The IRC defines a like-for-like property as any property held for investment, trade, or business purposes. Essentially, under Section 1031, the properties being exchanged must be used for either business purposes or investment. Therefore, an individual cannot 1031 a property that is their primary residence or vacation property. Investors can greatly benefit from using a 1031 exchange because it allows them to continue to grow their investment with their capital gains tax deferred. In addition, there is no limit to how many times a 1031 exchange can be used. Even though investors will likely have a profit with each swap, they can avoid paying capital gains for many years. When exchanging a property, if cash has to be held from the initial sale, it must be held by an intermediary. This is because if the investor has the money deposited into their account, it will spoil the 1031 exchange and they will have to pay capital gains. To use a 1031 exchange, there are two timing rules that must be followed. First, investors need to follow the 45-day rule. The 45-day rule relates to the amount of time that can pass between the sale of an initial property and when another property is designated. The IRC states that an investor can designate up to 3 properties as long as they purchase one of the 3. The second timing rule is the 180-day rule, which designates the amount of time that can pass between the closing of the sale of the original property and the closing of the new property. The 45-day and 180-day timelines run concurrently. Therefore, if a buyer doesn't designate their property until the 45th day after their initial closing, they will only have 135 days to close on the property. A reverse exchange makes it possible for an investor to buy a new property before selling the original. To do so, the investor must purchase a new property and place title with an exchange accommodation title holder, then designate the property for exchange within 45 days and close the sale within 180 days. Sometimes there's leftover cash from the sale of the original property. When this happens, it goes to the property owner, and they will have to pay capital gains on the amount received, but not the amount invested in a new property. 1031 exchanges can be excellent ways of deferring tax. However, their highly specific requirements means that a professional should be engaged to assist in the transaction. If the rules under Section 1031 are not followed exactly, then the 1031 exchange will be spoiled, and the investor's profit will be subject to capital gains tax. Exam Scholar, Real Estate Edition.